Australian defence company DroneShield manufactures products that detect and neutralize drones. After gaining 240% over the past year, the company now has a market cap around 769 million Australian dollars. After a recent capital raise, the company should have 150 million of cash on the balance sheet, which means the enterprise value should be 615 million. Meanwhile, DroneShield is experiencing excellent growth. Revenue increased 226% last year to $55 million, and Q1 revenue showed a 10x improvement on the prior year. The company also reported 9.3 million of net income and 7.7 million of free cash flow, which means the stock is valued at around 11 times revenue and 83 times earnings. The war in Ukraine has seen large-scale use of drones on both sides, and this has led to products being developed to neutralize that threat. DroneShield's products use radio waves and AI to jam drones and bring them to the ground without force, and these products are not only reserved for the battlefield, they can also be used to protect airports, stadiums and government buildings. DroneShield has reported revenue in these areas, but 70% does currently come from the military. The company won a $33 million contract with the US government last year and recently secured a procurement agreement with NATO. Additional smaller deals and a contracted backlog of $27 million suggests that DroneShield is setting up for another record year. And the company recently moved to a larger site in Australia that will allow it to meet a projected pipeline of over $400 million. So, based on a healthy pipeline and recent contract wins with the US government, DroneShield has momentum and it looks to be worth backing. However, there are some risks to consider. The first is competition. A recent report revealed more than 300 companies entering the counter-drone market. Not many of them have agreements with NATO or the US government, but competition from small and more established players as well is a looming risk to DroneShield's future sales. There's also a risk that drones become more sophisticated and able to evade jamming systems through the use of AI. Ultimately, it's not quite clear how strong DroneShield's tech is and how profitable the business can be long term. The company has high gross margins right now, but the average net income margin for a defense stock sits around 5%. Let's assume DroneShield is able to hit its target of $500 million in sales in 5 years' time and then operate with a net income margin of 10%. In that scenario, net income would come to 50 million, apply a 25 times multiple and we get a valuation of 1.25 billion, which works out to an annualized return of just over 10% a year. Account for 2% annual share dilution, however, and the return drops to 8%. Overall, DroneShield looks like a promising high-growth company and it's got the momentum on its side right now, but it's too early to tell whether the business will be able to return significant cash to investors. But these are my personal opinions, not financial advice, and I hold no position in DroneShield stock. For more investing videos, make sure to visit my website at 3minutebreakdowns.com. Thank you for watching.